In a world where change is the only constant, Mo Shamil stands at the forefront, guiding title professionals to not just grow their businesses, but to master the art of innovation. With every episode, you're handed the keys to unlock unparalleled growth and stay ahead of the curve. Get ready for a transformative journey.
Welcome to The Deep Dive, your shortcut to being genuinely well-informed, directly from the Title Agents Podcast. I'm Zina.
And I'm Crosby. Great to be here.
Great to have you. Today, we're taking a close look at the Q2 2025 earnings from the Big Four title underwriters.
That's right. We're talking Fidelity National Financial, First American Financial, Old Republic International, and Stewart Information Services Corporation.
Exactly. And our mission really is to cut through the corporate speak. We want to pull out the most important nuggets for you, our independent title agent listeners.
Mm-hmm.
We're going to explore what these market shifts really mean for your business and, highlight the key signals you should probably be watching as the real estate world keeps, evolving.
Yeah, and we'll keep this practical. Focus on what's happening behind the numbers, what it implies for your strategy, your next moves.
Good.
Just a quick heads up, though. This deep dive, it's purely based on publicly available data. It's for information only.
Right. Not info.
Definitely not legal or financial advice.
Yeah.
Think of it more like your executive summary, straight from the field.
Perfect. So let's get right into it.
Okay.
So let's set the stage first, the big picture. What's the overall vibe, would you say, in the title insurance industry for Q2 2025? Are we seeing any major shifts?
Well, what's really fascinating here is the kind of nuanced story that's emerging. While the residential real estate market, it does remain sluggish.
It's still slow, huh?
Yeah, largely due to those stubbornly high mortgage rates that have kind of stuck around since late 2024. But there's a definite silver lining.
Okay.
We're seeing a really notable uptick in commercial transactions, and even, interestingly, a slight improvement in residential refinance activity.
Refis are ticking up a bit?
Just a bit, but it's crucial because it's actively helping offset the continued weakness in traditional home purchases.
So not entirely doom and gloom on the residential side, which, that's good to hear. You mentioned prices holding up, order volume steadying. What does that signal for independent agents? What should they be thinking about for the months ahead?
It really signals a market that's finding its footing. It might be a gradual climb, but it's finding it. And a critical theme really across the board this quarter is this laser focus on operational efficiency and significant technological investment. Underwriters aren't just, trying to weather the storm. They're actively streamlining processes, leveraging cutting-edge tech, think AI, and expanding services beyond just title insurance.
Right.
And the real insight here isn't just that they're investing, but how it changes your potential relationship with them. They're building these integrated ecosystems,
Yeah.
And for agents, this means those who align with and really leverage these new AI-driven platforms, they won't just be more efficient. They could actually gain preferential access to leads, streamlined processes. You almost become an extension of their high-tech ops.
Interesting. So it's about adapting to their tech push.
Exactly. It's about mitigating risks, yes, but it's also about capitalizing on these new tech-enabled opportunities. It's a signal for everyone.
That paints a really clear picture of the macro environment. So let's zoom in now on the individual players. How did these broader trends affect the Big Four? What do their Q2 results tell us? Maybe start with First American Financial, FAF.
Okay, FAF, yeah. They really had a standout quarter. Posted strong results, comfortably beating analyst expectations, both on EPS, earnings per share, and revenue.
Nice.
Their secret sauce this quarter, a remarkable 33% increase in commercial segment revenue.
Wow. 33%.
Huge. And investment income also helped out, rising 17% year over year. That led to an adjusted EPS of $1.53. But what's truly eye-catching is their domestic commercial revenues surged by a whopping 46%.
46, okay.
Yeah, driven by a 17% increase in closed transactions and, importantly, improved average deal size, bigger deals.
That 33% commercial jump or 36% domestic, that's incredibly impressive. What's really driving that specific surge? Is it just the market or is it FAF's strategy? And how does that impact our independent agent listeners?
Well, it's a bit of both, but strategy plays a big part. This isn't just a standard cyclical rebound in commercial. We're seeing the beginning of what people are calling the wall of maturity.
I've heard that term.
Right. It's this massive volume of commercial loans coming due that's driving a really unique wave of refinance and transaction opportunities. And FAF, with their strong commercial teams, they're strategically positioned to capture this.
Makes sense.
So their strategy, it's kind of a dual approach. Fortifying that commercial business, investing heavily in talent, leveraging their underwriting capabilities, and B, continued heavy investment in technology.
Right, the tech again.
Exactly. They're pushing innovations like their Sequoia and Endpoint platforms, really driving for long-term efficiency. So for agents, this translates into more innovative tools, better support, plus strong underwriting stability, especially with their focus on digital integration that, frankly, should make your life easier.
Good.
Their CEO, Mark Seaton, sounded really optimistic. He anticipates the commercial refi market will stay strong for another year.
Fascinating. So First American is definitely leaning into that commercial boom. Okay, let's shift gears. Stewart Information Services Corporation, STC. Did they find similar success this quarter?
Stewart, yes, also delivered a very strong quarter, showed significant momentum, actually. They reported a 20% increase in revenues, and get this, an impressive 48% jump in adjusted EPS compared to Q2 last year.
48%?
Yeah. Their pre-tax income for the title insurance segment rose significantly to $49.3 million. And the real headline here, kind of mirroring FAF, is that domestic commercial revenues surged by 46%.
Same number. Interesting.
Right. Fueled by growth in really diverse asset classes, energy, data centers, hospitality, land development, their average commercial fee was over $16,000 per deal.
$16,000 average fee. That's substantial.
Which highlights the high-value nature of this segment right now. And what's also important for agents, their title loss ratio improved, down to 3.6% from 4.2% a year ago.
So they're managing risk well.
Extremely well. And for you, that means Stewart is running a very tight ship. Less likelihood of unexpected claim issues that can impact your clients or, your standing with the underwriter.
Okay, so Stewart is clearly gaining serious market share, especially in those high-value commercial deals. What's their strategic play specifically for independent title agents? How can agents maybe capitalize on this renewed strength?
Stewart's strategy seems centered on targeted growth, both organic and maybe some strategic acquisitions, particularly in key metro areas, MSAs, and specific micro markets. Very targeted. They're also investing in talent for their commercial teams and focusing on their real estate solutions business to gain share with top lenders. So for agents, this means Stewart isn't just regaining momentum, they're actively seeking partnerships in those high-value markets.
Okay.
Definitely keep a close eye on the tools and tech they're rolling out. It's all part of their push to modernize and compete effectively. They've also made significant progress integrating past acquisitions and tightening up cost controls. That signals a more stable, efficient partner going forward.
Got it. Okay, we've seen two big wins for commercial so far. What about Old Republic International, ORI? Did they keep pace, or is their Q2 maybe a different story?
ORI's Q2.
Yeah,
it was indeed a bit of a mixed bag for their title segment. It highlights a slightly different strategic focus, I think.
How so?
Well, while their consolidated operating income was up and their book value per share rose a solid 10%, which is, basically the company's net worth per share, a key sign of financial stability.
Right, rock solid financially.
Exactly, but their title segment's pre-tax income actually fell, down to $24.2 million from $46 million year over year.
Ouch. What happened there?
Their combined ratio deteriorated to 99.0%, which means, essentially, for every dollar of premium they earned, they spent 99 cents on claims and expenses. Not much room there.
No. Why so high?
Largely due to a $15 million litigation settlement and also higher agent commissions. They did see a 5.2% increase in premiums and fees earned, so the top line grew a bit, but profitability definitely took a hit.
Okay, so it sounds like some maybe short-term pressures they're dealing with. What's their long-term play then, and what should agents understand about ORI as a partner?
ORI seems to be taking a more measured, data-driven approach. Significant multi-year investments in AI and modern tech infrastructure. They're focused on improving operational leverage over time.
Playing the long game.
Seems like it. Their long-term goal is to get that combined ratio down into the 90-95% range. That signals a really strong focus on disciplined underwriting and cost control. So the key takeaway for agents here, While ORI might not wow you with explosive growth figures right now, they are positioning themselves as a deeply reliable partner, focused on stable underwriting long-term relationships.
Stability over flash.
You could say that. Their focus on efficiency and controlled growth means they're building a foundation you can depend on, even if it's less flashy than maybe some of the others chasing market share right now.
Okay, that makes sense. Finally, let's talk about Fidelity National Financial.
Right.
FNF, often seen as the giant in the room.
Yeah.
What did their Q2 look like, especially given the kind of diverse results we've seen so far?
Right, FNF. They reported a decrease in overall profit for Q2, down to $278 million from $306 million last year. But, and this is crucial, you have to look deeper, their revenue for the period actually rose by a healthy 15.1% to $3.635 billion. And the title segment itself performed robustly, brought in $2.2 billion with an industry-leading 15.5% pre-tax margin.
15.5% margin. That's strong.
Very strong. What actually hurt their overall company profit was investment volatility from their F&G business. That's their life and annuity segment.
So not the core title business dragging it down.
Exactly. The core title segment remained remarkably strong and highly profitable.
Okay, so revenue growth for the company, title segment strong, but an overall profit dip not directly tied to title.
Yeah.
What's FNF's strategy moving forward then? And how does their approach impact the independent agent landscape?
FNF's strategy appears focused on continued growth and, interestingly, operational simplification across their vast enterprise. They're actively pursuing strategic acquisitions to expand their business, enhance their financial profile.
Still looking for deals.
Seems so. And, like the others, they're investing heavily in technology. They sound very confident in their ability to deliver sustained growth and enhanced profitability. So for agents, FNF continues to lead in margins, showing they run a very efficient operation. They are clearly betting big on market recovery, fueled by tech and talent investments. And here's a strong signal. They returned over $290 million to shareholders just this quarter through buybacks and dividends.
That shows confidence.
A powerful signal of their financial confidence and stability as a partner, absolutely.
Okay, so after diving deep into all these Q2 reports, let's bring it back home. What's the real story for our listeners, the independent title agents out there? What should they truly take away from all this data?
Yeah, if we connect this all back to the bigger picture for you, our listeners, several key signals really emerge, things that demand your attention, I think. First, commercial deals are definitively back and booming. That wall of maturities we talked about, it's driving a unique surge. If you haven't been actively pursuing these high-value opportunities, now is absolutely the time to invest in that expertise. Learn how to capture them.
Don't miss that boat.
Exactly. Second, margins are improving, especially for companies investing heavily in tech and efficiency. This isn't just about their bottom line. It's a clear path forward for operational excellence that you, as an agent, can mirror. Leverage new tools, streamline your own processes.
Learn from them.
Right. Third, refinances may be starting to creep back. Okay, the residential market's still challenging, we know that, but this is a trend to watch really closely as interest rates fluctuate. It could be the earliest sign of a broader residential recovery.
Keep an eye on it.
Definitely. And finally, maybe most importantly for partnerships, all 4 underwriters are demonstrably financially strong. This provides a really stable foundation for your partnerships. None announced major M&A moves directly impacting their core title business this quarter.
Good point. Consistency.
Yeah, so your relationships with your underwriters should remain pretty consistent and reliable.
Okay, so the rebound seems real, even if it's, a gradual burn, and the underwriters are clearly preparing to scale again. What's the biggest message then for independent agents looking ahead, given all these insights?
Well, I think this raises a really important question for every agent listening right now. How are you positioning yourself now? Not tomorrow, but now. The market is actively shifting. And the successful strategies we've seen highlighted today, they all point towards adaptation, whether that's diversifying into commercial, whether it's leveraging technology for efficiency, or just strengthening those key underwriter relationships. The question is, are you merely reacting, or are you proactively shaping your future in this evolving landscape?
A crucial question indeed. And that brings us to the end of another deep dive from the Title Agents podcast. Thank you so much for guiding us through such a nuanced and informative quarter. Your insights are always invaluable.
My pleasure. Always great to connect these dots for our listeners.
And for you, our incredible listeners, remember the insights shared today aren't just numbers. They're really actionable intelligence for your business. The market is evolving rapidly, and staying informed. That's truly your superpower.
Yeah, and as you think about the ongoing opportunities, maybe driven by that wall of maturities in commercial and just the relentless push for tech transformation in our industry, maybe ask yourself this. In what specific, tangible ways can your business embrace these larger industry trends to secure your growth and your competitive edge in the coming year?
What stands out to you from this deep dive? Keep those thoughts brewing. We'll be back next time with more insights. Until then, keep digging, keep learning, and keep thriving in the ever-changing world of title.
In a world where change is the only constant, Mohs Shamil stands at the forefront, guiding title professionals to not just grow their businesses, but to master the art of innovation. With every episode, you're handed the keys to unlock unparalleled growth and stay ahead of the curve. Get ready for a transformative journey